Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX Capital, and welcome to our webinar on technical analysis. Now, sorry about that. ETX is a regulated provider, and therefore I'm required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risk. All information is provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. Any securities we show tonight are for educational purposes only. And for those of you that are joining us through an internet promotion and don't know much about ETX, we are a fast-growing financial services company based in London. We are authorized and regulated by the FCA, the Financial Conduct Authority, and we are a member firm of the London Stock Exchange. Now, when you trade with ETX, you have many choices. You can start out by trading on the ETX binary platform. It's a great place for novices to start, because all you have to do is predict whether an asset will go up or down, and the only risk you have is the dollar amount you type into your screen. Once you understand the financial markets and you kind of know how assets work, and you've tried to develop some strategies, you can move over to our ETX Pro, and you can either, if you're in London, you can do spread betting, or you can trade CFDs around the globe, or you can trade Forex. You can trade commodities, indices, and stocks on the ETX Pro platform. And if you want to move to a more advanced style of trading, you can download our ETX MT4 platform. And with that, you can start automating some of your trading on your own. You can use our advanced charts, and you can also add on the expert advisors that are hooked to the MT4 platform. But any way you want to trade, or as many different ways you want to trade, we'll make it available to you. Just contact customer support, and they'll get you on the right platform, or you can have multiple platforms, and they'll get you set up with anything that you need. Now tonight, we're going to be discussing what's called technical analysis. In the financial markets, there are two schools of thought, or two processes of analysis. Some traders are what we call are fundamentalists, or they use fundamental analysis. Fundamental analysis is like economic reports, speeches, central bank action, balance sheets, and income statements when you're talking about a stock, press releases. They are events and things that happen around the markets. Where technical analysis is all about using price action on charts and mathematical calculations to predict where price might go and where it is coming from. Now, the biggest difference of the two is fundamental analysis can maybe help you decide whether a stock or an asset or a security should go up or down, but no fundamental analysis will project how far an asset will climb, will warn you when an asset's about to reverse course, or help you set entry and exit points and stop loss points, because that can only be done with charts and price movement and volatility on the charts. And that falls in the category that we call technical analysis. So, understanding how the market works, learning to get the most out of the markets using technical analysis will help you trade successfully. Now, technical analysis is the study of market action, primarily with the use of charts, for the purpose of forecasting price trends. In its purest form, technical analysis considers only the actual price behavior of the market or instrument based on the premise that price reflects all relevant factors before an investor becomes aware of them through other channels. So a technical analyst believes he doesn't have to know about the earnings report or the central bank action or a jobs report, because it's already factored into the price of that asset, because the markets act and react so quickly, it adjusts price. Now, technical analysis is based on three major assumptions. Okay. And you have to understand these assumptions. But for all of its hype about being the scientific field, all based on mathematical calculations and price movement on charts and algorithms, it really is based on three assumptions that aren't so scientific. It is history tends to repeat itself. Price moves and trends, and the market discounts everything. So, keeping that in mind, technical analysis is widely used among traders and financial professionals. And some studies say it is more widely used than fundamental analysis in the financial markets. Technical analysis is a method that makes buys and sell decisions using market statistics. It primarily involves studying charts and showing the trading history and statistics for whatever security is being analyzed. To perform technical analysis, investors start with charts that show price and trading volume history, and then start adding things onto their charts. So the idea is to use a chart to identify trends and changes in those trends. There are several kinds of trends and patterns, some with unusual names like rectangles and triangles, inverted heads and shoulders. Then you have all kinds of indicators like Bollinger Bands and MACD and stochastics and relative strength index and ROC. There's all kinds of stuff out there. So some technical analysts also use indicators and oscillators to interpret trading data. Now, the thing about technical analysis, it can be as simple or as complex as you want. So if you look at this roadmap of London, it looks rather complex, especially if you're not living in London and haven't made this trip before. But if you look at this chart, this map long enough, you'll start seeing things. You'll start getting your bearings. You'll start seeing what it's telling you. Because a chart is like your roadmap to success. So once you've deciphered it, you can get it down pretty well. It will get you where you're going without getting so lost. Now, to give you an example, many years ago, before we had GPS, and you wanted to go to a meeting, and you were in central London, you got in the car, and you needed to go to a meeting way outside of London, you could get there a couple ways. You could call the company where you're going for a meeting and get detailed instructions of where to get off of the main highway, and then you could figure out what highway to get on to meet that main highway and follow those directions. You could be like me, I'll just get this little kind of odd map that'll get me on the right highway and off the right highway, and I would spend hours pulling into filling stations asking directions. Or you could have been like my business partner, who could read an atlas backwards and forwards. And he would keep one in the glove box of the car. Now, I know if I was going to a meeting with Peter, he would pull out that atlas and he would tell me what highway, how many kilometers to go, what to do on the roundabout. And if the traffic was bad or stuck or there was an accident, he would get us off the motorway, get us around it, because he could read that map down to the ultimate detail. Why? Because he had practiced it. He was familiar with it. Me, I'd look at a map and it would get me totally mixed up. But it's just like charts. Charts can be as simple or as complex as you want. The more you use them, the more you read them, the more you'll be able to add things on and understand what all these squiggly lines mean and what the colored lines mean and what the dots mean and everything else. Because the chart is the backbone of technical analysis and should be your backbone of all trading. So unlike fundamental analysis, which focuses on finding a security's true value, technical analysis is based on the belief that past market trends can predict the future behavior of the market as a whole. If an investor can correctly interpret a chart's message and predict a security's movements, he or she could obviously make a lot of money. Certain aspects of technical analysis are controversial, such as the belief that markets move in trends that can play out over a long period of time, and the contention that market action can detect shifts in supply and demand relationships. But there are many reasons that you should learn to use technical analysis. Now, if you stop to think that prices on a chart can give you clues into its behavior, and when certain patterns develop in this chart, you can use them to see where price is going, because technical analysis goes on the assumption that it's the psychology, the mass psychology of the markets that forces price movement. So to a technical analysis, the human characteristics of the market might be irrational, but nonetheless they exist, because investors' attitudes often repeat. Investors' actions in the marketplace are often repeat as well. Example is patterns in price movement will develop on a chart that a technical analyst believes have predictive qualities. Now, when we talked about those three assumptions, remember one of those assumptions was that history tends to repeat itself. Well, I'm of the assumption, of the belief, that that assumption is accurate, but it needs a little bit more definition. Because what I say is recent history tends to repeat itself. The reason being is traders believe that if a pattern existed and developed 10 years ago, okay, and you see that same pattern developing now, has nothing with price. If you see this triangle, this head and flag, this pennant in the price movement developing now, that the price should move in the same way because the psychology of the markets are pushing this price. And because traders react in the same way. I firmly believe that, yes, if you see recent patterns, you see a pattern that developed last year, 2 years ago, 3 years, like a head and shoulders, a flag, a pennant, a channel, and you see that similarly being developed now, I say it has validity. Not a pattern that we saw 10 years ago, because the characteristics of our markets have changed tremendously in the last 10 years. You know, when I started trading 40 years ago, there was only a few people in day trading, and there weren't computers. Well, there were computers, but they took up whole rooms and had to be air conditioned. So there weren't PCs. So we would go sit in a broker's office and use his ticker tape and his data, and we would sit there and do everything by hand. So the markets move slower. You couldn't get economics data as fast. The markets wouldn't react as fast. So it was a slow pace of movement of trading with only a very select few people actually doing this day trading. So we were a different animal. Today, we have all of these new retail traders like yourself and myself who have entered the markets, and we have a different psychological makeup. We come from different backgrounds, and we've all changed the psychology of the markets. So we've, with the growth of CFDs and Forex, we've all made very big changes. So that's why I'm saying patterns that have repeated themselves in the short term have a lot more validity than looking at prior price patterns. But sometimes you have to go back far because the pattern didn't exist or there wasn't something at a price. For instance, when the euro fell down to 108, 107, 106, it had never been at that price. So there was nothing that you could use in the past to compare it to. When it's moved back up to 121, 122, now we had lots of trading in this range, a couple years ago. So we had something that we could use that was recent. When gold shot all the way up, a couple years ago, it was at a new high. So there was nothing we could look at that had a comparable price level. So we have to learn how to read the charts and how to interpret the data we see on charts. So once you learn to use a chart, and tonight we're not going to be learning about using charts because we have a whole class called Charting Basics. And in that class we'll teach you the difference between Japanese candlesticks and bar charts and line charts and time frames and all of that. Okay. Because you have to have that basic understanding of what a chart is. once you understand what a chart is and the time frames and all the other things about subtleties of using a chart, you then have to start interpreting this chart. And we do this by using certain pieces of information that we can put on a chart. So the first thing we want to put on a chart is a trend line. Now you say to me, Barry, is that technical analysis? Anything that relates to a chart becomes a category of technical analysis. Whether it's a simple trend line, whether it's a simple moving average line, anything that we put on a chart is under the study of technical analysis. Now, I firmly believe there are three pieces of information that need to be placed on a chart no matter how you're trading, and these are, to me, are the fundamental cornerstones of any trading decision. Whether you're trading completely from fundamental analysis or from news or from earnings reports. Okay. Whether you were going to trade Walmart today because some good news came about at Walmart, they announced a $20 billion buyback of stock. Okay, well, if I was going to buy Walmart today, I would still want to look at a chart. And just a chart alone doesn't give you any, it gives you some visual information. And everything about charting is visual. But we need to put some basic cornerstones on there. And these depend on three pieces of information that we put on the chart. This is a trend line. This is a support and resistance level. And it's called volume. Now, these all fall under technical analysis, but to me, they are, again, those cornerstones. Okay. A trend line, the first step to identify the overall trend, this can be accomplished with a trend line. Moving averages or peak and trough analysis. For example, the trend is up as long as the price remains above its upward sloping trend line, or certain moving averages. Now, we have a whole class, in fact, we had it the other day, called The Trend is Your Friend. And we'll teach you how to draw a trend line and put it on and how to follow the rules. And that is the first piece of technical analysis you're putting on your chart. Then from there, we're going to put on what we call support and resistance. Support and resistance are areas of congestion and price lows where the current market, where the current price marks the support level. So a support level is what is supporting this current price. So, and the resistance level is what is holding that price down when it's moving upward, or reverse when it's moving down. So support and resistance is like price or the floors in an elevator. When you're in an elevator, what is supporting you? The floor below your feet. And what is above your head? The ceiling. In order to move up that building, you must break through that resistance above your head, and that resistance or that ceiling becomes your next floor. And then you have to break through the next ceiling. When the elevator is moving down, it is just the reverse. But these are the levels above and below the current price, and then move farther out, and they come in many forms. We have an entire class on support and resistance, but in order to find these, I use, and the most well-known technique is what I call eyeballing. That is looking for areas of congestion in the past that when that asset was at this price, what did it do in the past at this price? And if you can see common prices around the current price where the market tended not to be able to re-push above or bounced off and fell below, you can use that to project price now. So most investors tend to either be technical technicians or fundamental investors, though many analysts believe that the combination of technical and fundamental analysis is the best way to evaluate exit and entry points. Since many people rely or believe in technical analysis trading rules, at the very least the rules can become a self-fulfilling and making them important to know for the individual investor. And that's why we need to know these support and resistance levels and the trend levels, and then volume is how many contracts or shares have been traded in that asset, which helps tell you if the market or the overall traders believe in that price movement. And these all appear on charts. So let me pop up some live charts on your screen. And I've got one prepared for our class. So on here, we see lots of different kinds of technical analysis. And I'm going to turn them off, okay? I'm going to get rid of all of these that are below the chart because we have different types of analysis. They fall into different categories. You know, some are leading indicators, some are lagging indicators. You know, some go on charts, some go below charts, but they all go on a chart. Just some are below price, or some, like you see now, Bollinger Bands, is over top of the price on the chart. Now, what you see here in the blue line is a trend line that had been drawn on this chart from a recent swing high down to the most level swing high. And this helps us evaluate how an asset is moving. Because in the long run, the euro has been falling. Okay. It is an overall downtrend. Now we have a short-term uptrend here. We have a shorter-term downtrend. But in the overall, for the last week or two, the euro has been coming down. This becomes our trend line, and it becomes our resistance line. As price moves up here, it is most likely going to hit that trend line and bounce off. So it is the resistance line, and we can see how well that is held. Now, there are rules for drawing this trend line, but this is the first piece of information you've actually put on your chart, and it helps you define how price is moving. Because once you understand price action, you'll understand that price moves and pushes and thrusts, push and thrust, push and thrust, push and thrust, because that's how a well-developed trend moves. Okay. But this price doesn't move in a straight, hardcore direction. Price goes down, moves up, goes down, but it is overall easing down. Okay. And you want to see this well-developed trend of ease, thrust, ease, thrust. Now, there's also rules about these eases and thrusts, but we need to be able to interpret them. So once we have our trend line on there, like I said, the next piece of information we want to put on this chart are our lines of support and resistance. This helps us predict, as the price moves in the current price, where we might expect price to get support if it's easing down, and if it's moving back up, where it would get resistance. Now, there are many ways to get this price. Like I said, one of the most common and the longest used and the most dependable is what I call eyeballing. And what we would do is we would look around price, and we would look to see if we could find, so price is moving around here right now, 117.05. If we go back, we can see, and what we're looking for is price levels that have been statistically important to the market around the current price. So look at this. We take all the highs. Look how crucially important this 117.596 was right here. Right here. That was a very big swing low. Right here, we have the candle that stopped right at that right price. Here, when price moved back up to that level, it couldn't break through it and fell back down. Here, again, we touched that level and fell back down off it. Here, we had lots of swing highs at that level. But here, again, we had lots of congestion at that price. So that's telling us that price is very important to the market. So that price level, okay, might be what we call the resistance level. When price is down here at the moment, hold on, let me clear off these markings. So price is down here at the moment. If it starts moving up, we would expect to get some resistance at that level, because that has shown us that that price is statistically difficult for the markets to, doesn't say it won't go through it. It just says we might get some hemming and hawing at that price. We might get some ease at that price, or it might bounce off that price and come back down because it's met its resistance level. But when you combine that with our trend line, which is also very important at this level, and we add on a third piece of information called volume, by adding it onto our indicator selection, and when price is moving, and we have price moving here, it's moving below that trend, that support line is moving right on that trend line, but we see that the volume is fairly low. We don't see it peaking up, We don't see it climbing. So that means the traders aren't fully certain that price is going to continue to rise, because remember, we ease down, bounce back up, and there's no belief that they think price is going to continue rising up, because otherwise they would be entering the market to trade it to go up. And we can see from the volume down below, the volume is quite low. So together, we're using this as our just as our cornerstone, our foundation for understanding where the price is at present. But all of this falls under the field of technical analysis. This is very simplistic technical analysis, but it gives us some basics for reading our chart and maybe making trading decisions based on some other type of information. Like I said, when Walmart announced their buyback, their shares climbed up. Well, if you saw it on the chart, you saw the price moving up, you saw the volume increasing, and you saw it break its resistance level. That might tell you, or you're waiting for it to get up to its next resistance level. You saw it go through there. You're saying, okay, this move up has a lot of support to it and broke that resistance. So I might enter my buy position. Where if it moved up to its resistance level and bounced off and couldn't get the momentum to go through it, you're saying, okay, it's maxed itself out. So it's helping you build your roadmap. It's helping you decipher what is happening here. Now, after this, we go to what's called technical indicators. Technical indicators are all of those confounded things y'all want to deal with, y'all want to talk about. And these are things like RSI, stochastics, MACD. These are oscillators and indicators based on mathematical formulas. But before we go on here, we also might want to look for something called chart patterns. Patterns are like head and shoulders pattern, which is a triple high, and there's rules about it. And you can come to our class. We have a whole class on the primary chart patterns, how to find them, how to read them, how to interpret them. You might be using Japanese candlesticks and learning the 32 different positions of the candles to make interpretations. Because your technical analysis, your technical indicators and oscillators, which everybody wants to use for as their main decision maker, are really your secondary decision maker. Because price action is your primary decision maker. So locating triangles on a chart, okay, which are patterns that are very informative, excuse me. Sorry about that. Because patterns on charts can tell you what's happening with the market. You can see the pent-up demand moving in a pattern, and when the price breaks that pattern, it can break out and break up, or it can break down, but when it's got that, excuse me again, when it's got that pent-up demand, okay, and you've seen this pattern, you've seen the price moving into the center, the edge of this triangle, you know it's going to break out one way or another. So chart patterns are part of technical analysis because they occur on your charts. From here, I don't have a chart I can bring up for you right now with chart patterns. So this is what happens with technical analysis. From here we go to the area that's known as indicators and oscillators. And these include things like Bollinger Bands. Bollinger Bands are a mathematical calculation that are dropped on directly on the price chart and help you, number one, see the volatility. And Bollinger Bands are said that between these bands, these red lines outside yellow, and I just colored these in for you, okay, you can actually determine all the price action and find entry points, where to put your stop loss, where to put your take profit, because all of that will occur within these bands. But that's learning how to use this indicator. There's thousands of different indicators. Okay, there are the primary ones that we all know about, so that was Bollinger Bands. Then the most popular in the market is called MACD, moving average convergence and divergence, and see that is dropped below your chart. And MACD is known as an oscillator, I'm sorry, as an indicator, and it's one of the few leading indicators that will help you predict price action. But we have if you see here, we have the orange line and the blue line. One is the MACD line and the other is the MACD signal line. And when they cross, they are telling us to do something in the markets. So when we see the crossover, it's giving us a signal to buy or sell. Now, it's not that easy. I'm giving you a simplistic explanation of the indicator only because we're not here to learn how to use a particular indicator. We have a whole class in MACD because it's not that simple. You have to learn more about the strategy before you're going to risk your money on it, and you have to learn how to read it in detail and how to use it. But these indicators that are dropped on your charts, whether they're below your chart or over top of the price movement, like a moving average, are, as anybody would tell you in the markets, they are your secondary method of making trading decisions. Okay. Too many people want to put these as their primary trading decision maker, but they're not. Okay. Price action and price movement, trend lines and volume should be your primary decision makers. All the other indicators and oscillators are support mechanisms. They help you define or support or point out maybe you're making a wrong decision. But they shouldn't be your primary method, and none of the methods should be used as a single method, because you cannot rely on one particular indicator. And indicators might work well in one market and not work well in the other. And that's why you have to have many different indicators and oscillators that you know. And when you see it's not working well in this current market, you put it away for a while and you use a different one. So you have to have many different strategies. Now, these indicators fall into different categories. You have volume indicators, you have momentum indicators, you have trend indicators. And you have to learn each type of indicator and then what you want to use and how you would interpret that indicator. Because you wouldn't want to have 3 different overbought, oversold indicators, because then you're just being redundant and you're missing all the points. So those are indicators like RSI and stochastics, which are 2 of the more popular ones. RSI is Relative Strength Index, which are also dropped on your chart below. And these are called what we call bounded indicators, because their mathematical calculation will always come out between 0 and 100. So they are bound between that 0 and 100. And they have a range above from 0 to 30 that would tell you the market is overbought, and 70 to 100 that would tell you the market's oversold. Anything in between, which is the purple area here, is completely ignored. Okay. Now, again, I'm giving you the simplistic explanation, but they are called bounded oscillators, actually, because they are bounded in this range. So MACD above is a non-bounded indicator, and therefore would work well with RSI because they both tell you something different. MACD will also give you 3 different interpretations of the market. It'll give you convergence, divergence, and crossovers. And RSI will tell you when a market is overbought or oversold. Because an overbought market means there's too many buyers. The prices have been driven up too high. But an overbought market can continue being overbought for a while. An oversold market can continue being oversold. But it's just telling you there's too much weight, or the prices move too high or too low at this point, and the market should change itself. So we have all different types of indicators and oscillators that make up the field of technical analysis. So let's go back to my PowerPoint. Now, what you're simply doing is you're building your roadmap to success. The more information you put on your charts, it'll look like that complicated roadmap, but when they become your indicators, you're putting them on, you pick the colors you want to see them, and you know what those lines mean to you because they are part of what you built. Well, guess what? You can read that roadmap pretty well. And the more detail you put on there, the more likely you're not going to get lost. The more likely you'll realize when there is roadworks or when there's an accident, and you'll know how to get around it. It'll give you a forewarning. It might even tell you that there's a schoolyard up there, so you know you want to avoid that area the time school's letting out. But if it's Christmas holidays or it's summer recess, you know you can go right through that area at 3 o'clock. Okay. So there are things that you want to know. Or perhaps you're going to a meeting going through that way, and you see there's a great big parade, and there's a garbage truck right in front of you, and then a parade in front of that. Well, you need to know how to get around it successfully, or what it's trying to meet, or how many more blocks can you go before you have to make a left and get around that traffic. And these indicators and oscillators will help you do that. They'll help you build your roadmap to trading profits. So again, charts are one of the first things you need to learn, because price is displayed on these charts. And they're displayed as line charts, bar charts, and candlestick charts. And the more detail you add, the more likely you are not going to get lost. Because if you look at this, this is a line chart. It's the bare basics. It gives you no information, just a general feeling about how the markets are moving. A bar chart, okay, is the most informative chart that doesn't have prejudicial things to it. It gives you the open, the high, the low, and the close in a very visual, easy to see format. And each one of those bars shows you the open, the high, the low, and the close in the time period that you've set up your chart. So this is an example of a 30-minute chart. So each one of those bars you see gives you valuable piece of information. It also helps you find those lines of support and resistance fairly easily. Because look at this, when we look at price, we can see here a whole bunch of important prices. Okay. It also helps us draw our trend lines easier because we can see the peaks very easy. Now, the third chart type is what I mentioned earlier, Japanese candlesticks. And candlesticks are very similar to bar charts. They contain the exact same information, the open, the high, the low, and the close for that time period. So this chart here and this chart here are for the same asset for the same time period. They show you can see visually almost the same thing. But what candlesticks do is they color in the body. And unfortunately, our mind has reactions. And when we see lots of red, we think of down. When we see lots of green, we think of up or go. And this is not what candlesticks are about. Now, candlesticks are a great technical analysis trading system. And therefore, you have to learn all about what these candles are telling you. Because there are 32 different patterns of candles. And it's very little to do with the reds and the greens. It has to do with the shape and the size of the body of the candle and how it is placed next to the candle before it and the candle after it. And these are called positions. And these positions tell you something. Like you can see here, this candle has virtually no body. That tells you something. This candle has no body. The open, the close were exactly the same. That candle tells you something very specific about the markets. And this candle is actually called a doji. And you have to know exactly what a doji is. So you're not looking for the reds and the greens. There's haramis. There is marabuzus. There are 3 black crows and 3 white soldiers. And this, you have to learn what all of these patterns mean. But it still falls under the area of technical analysis because it's all done with charts. But Forex trading attracts many different types of traders, many different types of systems. If you want to trade a currency pair, it's best to become as familiar with it as possible. So one of the best reasons to learn how to read a chart properly is so that you can learn to apply technical analysis. Not every trader believes in using technical analysis, but it can be useful even if it's not your primary method of trading. Technical analysis relies on the price that is on the chart you are using. And the more information added, the more likely you are going to arrive successfully. Now, doesn't this chart that's popped up on your screen look very much like this roadmap? A whole bunch of squiggly lines and a whole bunch of different colors with a whole bunch of numbers and symbols on. Doesn't that look just like the map of London? But in no time at all, you'll actually be able to understand this and interpret it. And especially when it's you who put all of these on your chart, because you know exactly what you put. You know the order you put it, and you know what color system, because you can set, candles are basically red and green, but you can make candles orange and purple if you want. Okay, one color denotes the bullish and one color denotes the bearish. The old days, candles were just black or white because they were easier when you were hand drawing your candles. Then the reds and greens came into play when we had computerized charts. And now you can actually change those candles. And like I said, if you want pink and purple, you want gray and dark brown, you decide. But once and every one of these indicators, you decide what you want. So you can have them all color coded so that you can interpret them easily. So even perhaps here, this is a fairly simplistic chart. When it's your chart and you put these lines on your chart, okay, you can start making sense of them. And actually here, this is actually a chart pattern that's developing. We have a channel that developed right here. And you say, how do I know that's a channel? Well, there are rules about what a channel is. Okay. And you will learn those in our class on chart patterns. But when a channel develops, we're expecting, as price moves farther and farther in this channel, we're going to expect what's called a breakout. It's either going to break down or break up. When it breaks out, there are rules about the momentum for the break that will give you what your target point is. It will help you with your stop loss and where to put your take profit points when they develop. Okay. Again, we can see here the projection for the price movement is to come down to this Fibonacci support level, move back up, ease back down, and move back up, because that's how a proper trend should be moving. So we're looking, and these are resistance lines and support lines, and this would help us set our buy zones and our targets and everything we need to know. So there are numerous types of patterns, all named according to the shapes and the price the graph forms between the support and resistance lines. These patterns are known as triangles, channels, wedges, head and shoulders. Okay. So there are rules. When you see this triangle develop, and we have three different triangles, the symmetrical, asymmetrical, and descending triangles. And when we see price move into these patterns, we're going to expect a breakout, because when we get to the point of the triangle, we have huge amounts of market congestion, and the traders are forced to make a final decision. Are they going to trade down, or are they going to push it upward? And there are rules that will help us understand what happens here and how we could make successful trades using the development of these chart patterns. Okay. Rectangles, like I showed you on the previous chart, and channels, wedges, and they all have very specific descriptions. Then here we have head and shoulders, which is the most relied upon chart pattern. And it looks just like a head and shoulders. But when it's forming the left shoulder and then goes down to form the neckline and forms the head, you don't see it yet. It's not until it starts to form the right side shoulder. But when you see that right shoulder developing, you can then predict exactly where price should be going from that point. So you have trend lines, you have support and resistance lines, and they all help us understand what is happening with price. And they are pieces of information. These pieces of information can give us clues to what we can expect. So, like I said, we have whole classes on how to draw trend lines. We have whole classes about eyeballing support and resistance and how to use pivot point support and resistance, how to use Fibonacci support and resistance levels. Then we go on, we talk about the volume. We have a whole class in chart patterns. We'll talk about every pattern, how you find it, how you spot it, and then what the calculation is to figure out when it breaks out, where the momentum should take that asset, or what the target point should be, and where to put your stop loss. Okay. So there are many simplistic pieces of information. It's not till we get on to the complicated technical indicators that are put on our charts do things get really complicated. Okay, and we also have, so we have a class in charts, we have a class on support and resistance, we have a class on trend lines, and then we also have classes on individual chart patterns. Indicators. So we have a whole class on using MACD. We have a whole class on Bollinger Bands. Okay? And you can simply slowly build your understanding of the market, and you don't have to use any of these. Like I said, if you just use trend line, support, and resistance and volume, whole trading systems are based on those three pieces of information. And next month we're adding a, ETX added Bitcoin to their platform. So at the end of this month, we're having a class in Bitcoin, how to evaluate Bitcoin, what the Bitcoin VIX is, how to trade Bitcoin in CFD format, and how to predict price movements using technical analysis for Bitcoin. And then after that, the following month, we're adding a class in the 5 types of technical indicators, so that you can, we'll break them down by which are momentum, which are trend, and what leading and lagging indicators, what centered indicators are, and what classification, so you can start picking the right indicators. And so we have lots of new classes coming up for you over the next few months. And then we also have a class on advanced Forex trading that we'll be adding in. So thank you very much for joining us tonight. Thank you for being part of ETX. And hopefully we pointed out some things that will give you a start. And like I said, we also have a class on advanced technical analysis that we'll be adding in. So you can start with here and then join us for the other classes and move along and get a good understanding of how the markets, how you should be able to interpret price movement and price action to make smart trading decisions. So have a very good night now. You can get a copy of this class, or you can access a recorded copy of this class by using the same link you came to tonight's presentation, and give us about 24 hours to get it up in place, and you'll be able to see this class in the recorded format. Thank you very much, and again, thank you for being part of ETX. Good night now.